Uh, well, I trust everyone can hear me and see me clearly. My name is George, and welcome to this bar by bar trading. What I'm going to do shortly, I'm just going to put up my charts so we can all have a look at them. Okay, so what we have here, what I want to just show guys is how I approach each trading day. But I'm not sure how many of you were present in the presentation that took place a few weeks ago, where I showed starting off at the higher time frame chart. So I'm going to start with that on the euro. There's three currency pairs that I'm looking at that we're going to be discussing. Now, feel free to post any questions that you have into the chat box. And during the day, during the next couple of hours, I will be able to answer them at some point. So the very first thing that we're looking at is the euro monthly time frame. What I do is I always want to have a big picture view of the currency pair that I'm trading. So if you don't trade any of the currency pairs that I have, this is the approach that I recommend that you take. And again, if you need clarity at some point, we can definitely go through that and discuss it. So I go to the monthly time frame, and a real big. So there's quite a lot of information here, but you can see, at a really macro level, if you really scratch the chart down, you can see that at some point, the euro reached a high and it's been tracking downwards, in a bear trend, but we have broken out of that. In the last few months, we broke out of that. So at the highest level point, I know there's buying pressure that's in the euro. But the fact that we've broken out of the channel does not necessarily mean that we are in a steady bull trend, because the bears that created the channel will still be in the market. Let's do this. Okay, so just a bit of a closer view to what we're looking at here. What I'm interested in when I look at the monthly time frame of any chart is, are there any levels that are coming close into the daily view? Because if they're coming close to the daily view, they're definitely going to be acting as magnets. In other words, they're going to act quite determinedly to pull the market up or down. So as you can see from this chart, our bear trend line was broken in July 2020. And everything that we had with COVID and the impact it had on the market. But you can definitely see when things started to change, things started to track upwards. In July, we had that resurgence. And I'm sure if you look at macro fundamentals, you understand the things that are happening in the market, both from the virus perspective and other things happening in the Eurozone. Now, from a price action trading perspective, I don't pay much attention to what is happening in macro fundamentals. All I do, I have on another screen, I just have my Forex factory open, and I've set up all my filters to indicate red news that occurs within a day. For example, I know this week we have, yesterday we had the Fed Chair Powell testifying. Wednesday again 5 p.m. My local time, which probably will be I think 11 p.m. or so Singapore time, if I'm correct. We'll be testifying. So it's those key levels, those key news events that I'm interested in, and I'm only really interested in seeing the impact that we're likely to have on the currency pair I'm trading. So I'm pretty I have a general sense of what's happening in the world, but it does not come into my price action trading on the 5-minute time frame that I'm working on. So if I look at what's happened now, the most dominant price action was this break above the trend line. And then this pattern here, this pattern is a breakout pattern where it's a form of a triangle. The market is squeezing into a particular zone. And at some point in time, the market will not end up in a straight line. It is going to break out. Either we break out above the little pattern, which will be the same. Also, the breakout above this high that we have, which is a February 2018 high. And once we have that breakout, I always have to wait to see if it's follow through. So if you're talking of a monthly time frame, here we have the breakout above the trend line, but you have to wait for the following month to see if the breakout is successful, and then look for your setups going long. The other thing that could happen, of course, in that converging triangle, because it's a pattern, a triangle pattern that's converging to one point, is that the market at that same level, this previous lower high, this previous turning point, the market could bounce off that and create a double top. Now, if it creates a double top, what it means is that the bears who had created this lower high are still strong enough. They were not strong enough to prevent the market turning it. This is a failed breakout because it was resumed. But if they're able to create a double top, it means there's still opportunity for the bears to come at a lower high and maybe push back to get to the lower price level. So what is of interest at this particular time? There's just a window I need to move from the screen. Let us see how to move it. Please move this window. Okay, Windows gone. Windows back in the wrong place. So, try to get a bit familiar with. Thank you, guys. So that level there, that high is a level where the market could turn, and you see it's a high of 2018. Okay, that's a high of 2018. That's a key level, which I will pay attention to on my 5-minute time frame. There's also a couple of other levels that I just think are important to watch, which, when I open my charts, I'll just have a look at. I've made a note here that 1.3 is a potential powerful magnet that will pull the market up. Now, why would I say 1.3 is? Because 1.3 is somewhere within this zone. So in the middle of that yellow rectangle that I have, 1.3 is. Now, the reason I'm saying it's it's a powerful magnet that is likely to pull the market up, which I just have to bear at the back of my mind, because again, it's a monthly time frame. It's pretty far away from daily charts, but that level, that round number is significant. The reason it's significant is this. At some point, we had this very strong bear trend and bear breakout from May 2014, which ended in 2015. And then the market went sideways. The market created a trading range before we had a bear resumption. Now, whenever I see a trading range or a pattern that is signifying to me potential break, do we have a breakout? To what extent is price going to search for a measured move? Trading range here. The measured move is the height of the trading range from the low to its height, from the low to its top, and then a similar extended move all the way up. What you find with price action is that, or price action trading, the market tends to search out specific things. It tends to search out on a breakout, a measured move out of whatever it is breaking out of. So in this case, it should be breaking out of this trading range, and the measured move is right here. Now, that measured move is one thing that I always mark and say, I keep it there. So this is the measured move, the TRBO measured move, trading range breakout. So the 2015, that whole period, 2016 trading range, measured move will be there. So I leave that there. And what else would I have to look out for? Because one measured move is good because market tends to react there. And the reaction is not necessarily a reversal, but the reaction typically would be profit taken at that level. So if you'd initiated a long in this area or anywhere in here, and then you had a breakout, you always want to say, well, where are the big institutions likely to take profit? And if I can identify where they're likely to take profit, I can also start to consider where I can most likely take profit in my trading. So we then have the market breaking out. Now, measured move, keep that in mind. So you see a lot of these measured moves. And when I put them, typically I know what to look for, but sometimes you need to take note of the acronym. Another move that you will see is what I call L1 equals L2. And that L1 basically means leg 1 equals leg 2. So the market tends to move in two legs in a direction, to have a first leg up, a pullback, and then a second leg up. Or if we trending downwards, it could have one leg down, pull back to some level of resistance, a measured move, so not measured move, moving average, and then a resumption. Now, the height of the leg 1 tends to be typically the same height as the leg 2 after resumption of the trend. So in this case here, my leg 1 is this whole move. Okay, then I look at and see where is market pulled back and resumed. Now, by review of it, by definition of it, what you always see first is the measured move that you track, the measured move out of whatever the market is breaking out of. That gives you the first indication where you can start to look at to take profit. Then thereafter, you need to come back and wait until you get a resumption after the pullback. And when you get that resumption, then you have the opportunity to work out your leg 1, leg 2. So my leg 2 ends here. If I just double click on that, you can see how that's moving. And I'll show you how to set this up at some point. So now I have two hidden levels. I call these hidden levels of resistance. Measured move is hidden. Leg 1, leg 2 is hidden. They're all doing 1.3 revenue. So that's how I come up with a pretty significant move. Now, I just want to jump down to the 5-minute time frame on the euro. I'll come back and look at the higher level analysis because we also live in the market. So a couple of things that will become familiar with are always mark the beginning of any trading session. In other words, you check your stock exchange, you quickly mark that, and I use this magenta, this purple line, just 5 minutes before the market opens, because I want to see what is going to happen at the open. I want to start to look for opportunities at the open when the market kicks in. Now, this rectangle that you see, the other thing I look for, I always try to find, if I don't see I want to see a 20 pip move because I'm not comfortable on a 5-minute chart. Market is at a 20 pip move. That just indicates of what it is now. Because I do this quite often, typically once I've said it was to give us an indication of what's happening. Now, it does not necessarily mean that the moment I see a 20 pip move, I start to take trades. But and now my mind is now geared up to for me to execute a trade. The other thing that's through the end of the 18th bar chart. So 18th candle is 90 minutes later, and that's around 11:30. So that's 11:30 from 10 o'clock my time to 11:30. So you'd need to add this on your own time. The reason I put that there is that typically by the 18th bar, the market is either shown a definitive move and shown either a high of the session, a low of the session, and I can start to compute in my mind where I can look for opportunities. So at this time, we have a low of the session with the high of the session. It's still a pretty tight range. So I'm not hugely excited about taking new trades as to the double top or two-bar reversal, and the market is talking to test this low. So I'm very interested to see are the bears going to be strong enough to break out beneath the low of the session, which is also going to be breaking out beneath the open. This purple line indicates the open of the day. So I would have marked this from the daily chart. If we were to just go back, you can see it much earlier on here. That's the open of the Asian session. So that's where, but I would have picked this up on the daily time frame. That's where I pick up when the market, the open is, when I insert that in there. So just at this stage, just want you to kind of bear in mind just these three things. So mark the open of the trading session, 18th bar, 18th candle, which is 90 minutes, 1.5 hours later, because it gives me a sense of what has happened in the first 18 bars, 13.5 hours. Sometimes, you have different patterns which we talk about, where the market has got in the earlier session, it has come back, given you a nice 20 pip move, and out of that you can start to take a trade. So as it is on the euro, we're going to wait. You could extend that 20 pip range to there, but let's just keep it there just for clarity. Other thing you need to see, I would have marked also the green is the high of yesterday, and the red is the low of yesterday. These are very significant because these are key support and resistance levels on this time frame. And when the market gets to those, either you're already in a trade and you wait to see if you get a breakout in your direction, or you wait to see if the market bounces off that and reverses back into the range of the day. So far, only 5 things. We have the open of the day, we have the high of yesterday, the low of yesterday, and we have the open of the session. So the purple solid horizontal line is the open of the day, and then the dotted purple vertical line that shows the open of the session. And you'd have this for any session. Typically, the Tokyo session, it's for me, I put it at 2 o'clock my time, and I'm in GMT plus 2, so they open GMT plus 2. And I'm interested, if I'm up early, to trade that first 2.5 session, the morning session of the Tokyo Stock Exchange. But we will look at that. Let's just jump to the CAD. As I said, there are three currency pairs that I'm looking at, and we're able to look at some more as we progress. So in terms of the Canadian, I'm just using shortcuts. So it's Euro, Dollar, USD CAD. I'm trading measures. So when I say CAD, when I say Euro, I'm trading measures. Euro, Dollar, USD CAD, and USD. That's the currency pairs that I'm trading. Other day I was talking to one of my trading colleagues, and he was saying, why would you look at now at those three currency pairs? And it's really looking at the most significant pairs that go into the US dollar index. If you do a study of that, you find the greatest percentage of that would be the euro, the CAD, the yen, and the pound sterling is in there. But because of the correlation between the pound and the euro, I just decided to drop it out and just focus on this. Again, you'll see the same kind of thinking that we need to carry along. High of yesterday, low of yesterday. High of yesterday is a green lime color. Low of yesterday is a red color, very significant on the 5-minute time frame to see how price is reacting. So you can see at the present moment, again, we're still in that 20 pip range from the open of this current session. So what I found useful is to think of trade, although the currency market is a 24-hour market, is useful unless you trade in the whole day. And I love to be able to get up and look at trade opportunities in the Asian session if I can do that. And if I see trades by the time that first session, that first Tokyo session ends at 4:30 my time, 2:30 GMT. If I'm in a trade, I put the stop in the right place and let it carry on. But otherwise, I want to, unless the trend is distinctly bullish or bearish, I close each session as I go up. And having said that, I trade the three opens of the sessions. And the Tokyo session is a pretty crazy one because my goal is to get up consistently and trade it from 2 to 4:30, those 2.5 hours. But then I can go to sleep for another hour in the quarter, and then get up, and get involved in the family stuff, go running with my wife, take the kids to sleep, but be back in time to trade the European session, which opens my time at 10 o'clock my time, which is 8 o'clock GMT. And now in that session, I'm interested in what's happening on the open. And these days, are not uncommon where it's not very clear what's happening on the open. So to avoid just jumping in, I have this rule that I need to see at least a 20 pip move to begin to trade. Now here we're still within that 20 pip move. I mean, if we're oscillating around the low of yesterday. I'm gonna come back and look at the high time frame, but let me just go into the daily. I mean, you can see just on the daily here, we just really at the low of yesterday. The market is deciding whether at this level of support can just break through and create a low, or we're going to have a pullback, and that tail becomes the low of the day. So that's what we're seeing reflected here on the 5 minutes. So again, we're waiting. Now, let me jump to the yen. So something very interesting happened on the yen. 5 minutes. Again, you start to notice now as you start to work through this. Low of yesterday, high of yesterday. I mean, I just picked this off. If you go to a daily time frame, and you just hover over the previous day, you can pick your high and your low, quickly go and plug them in. If you look at today, just look at the open, just jump onto the open and quickly plug that in. So that's where that information comes from. It's pretty quick to put it in. Now, you also then have the open of the session, and then that 1.5 hour that we spoke about. Now you find the open of the day at horizontal level occurred way back in the Asian session. So let's have a quick look at that. So here's what transpired. So that was my 5 minutes before the 2 o'clock open, when the Tokyo Stock Exchange opened. Okay, then the market pulled back to the moving average, and we had the bullish move right up to where we had the high of yesterday. Then kind of track sideways. Now until the open of the European session, there, at the opening of the UK session. Now that kind of presented an interesting problem for me, because that setup that we had is a tight trading range to the moving average. It's right at the top of the Asian session trading range. So what is it? It's an area of resistance. Now, one thing you don't want to do is buy at the top of a trading range, because you should be selling at the top of the trading range and you should be buying low. So as the market opened, I was interested to see if the market would come back anyway into this trading range here, and see if I could get another double bottom, high low, and on achieving that, to see if we get an entry to go long. But as it turned out, right at the top of the trading range, and I would have found it difficult to buy this level, but it carried on tracking upwards, and it became what we call a tight trading upward trend. Okay, in other words, the technical term is a small pullback bull trend. So it's a bit of a mouthful, a small pullback bull trend, but think of it as a tight trading range sloped upwards. So the market is going up in a very tight channel. So it's a small pullback bull trend. Why is it a small pullback? Because there are no credible pullbacks to the moving average that you can say, okay, hang on, I see that two-legged pullback to the moving average, it's tested the moving average, it's tested the breakout point, let me take the trade. Now, could you trade this? You could. The only way you could trade this, if you want to, is if you put your stop in the correct place. The correct place to put a stop is always at the low of any breakout before you get a pullback. So if you're going to take a trade anywhere in here, the correct stop is right here. Because if you don't do that, if you were to look at any chart where you have successive bull bars with small pullbacks, chances are at some point there'll be profit taking. That profit taking could be quite dramatic. Whatever trade you take could be wiped out very quickly. So if you take a chance, say, well, let me take it there, let me put the stop there. Here it looks pretty neat, it's going your way, but you could have dramatic reversals, which are not surprising because the correct stop is down here. So buying above, buying at the high of a trading range, it's not something that will make you money in the long term. It looks good now, but I wouldn't. It's a low probability trade. So what now? Well, now we have to wait and see what pattern forms for us. Is the market gonna keep going sideways? Because now we have a trend, we have a trend break. But if you have a trend break after this kind of move, you need to wait to get to the moving average and see if you get a double bottom. If you get a double bottom at the moving average, that is a setup. All you need then is either a higher low to continue, see if you get a second leg of that. Or if that double bottom fails, you want to see if there's an attempt to break beneath the double bottom and a resumption. But we'll talk a lot more about. There's a lot of patterns that we talk about. Now, I want to just try and connect. Let me just check with you. No question. I just want to try and connect a couple of things. While we were looking at the euro and talking about the 1.3 as a powerful magnet that is likely to pull the market up, I explained that my reasoning for that was firstly the measured move breakout above this yellow triangle, which gets us in the 1.3 zone, and then also the second leg of this first move, where is leg one. So the first leg went up to when the distinct pullback started, and then where would the leg two start? The leg two will start where the pullback ends. So the pullback ends here. Okay. Pullback ends here. So the market will then go leg one, pullback, and leg two to get to this level, which is almost the same level as that measured move, which is 1.3. So now if you look at what's happening on the yen today, let's try and correlate that. We couldn't get into this first leg because it's a tight trading range, turned upwards. The correct term, let me just put it in there so that you can just see it if I start to use an acronym. Pullback. Good. Small pullback. Small pullback. Good trend. So when you see that marked somewhere, sometimes that's an acronym. That's the trend that I got. Just give me a second so when I check my Wi-Fi. I keep saying that instead I'm not sure why. Okay. Let's see if that works. Sorry guys, there's a fiber here and I'm not sure why it's talking about it. But anyway, I think we can carry on. So this first leg here, that is leg one. So the way I would mark my leg one and where potentially market could go. So I go in sets, I go to Fibonacci, I have a tool called an expansion tool, there's this leg two. And all I want to mark is where did the leg one begin. So the leg one is beginning here, and where is the leg one ending? Just to expand that a little bit. Okay, so the leg one is ending somewhere within there. Okay. I have a window that keeps popping up, but I'm not sure. Okay. Now that's leg one. Where would leg two resume? The leg two, see where our pullback is? So in there somewhere, that's where the leg two is resuming. The leg one is ending here when we start to have the pullback, and the leg two is resuming there. So once I have that, leg one, pullback, leg two, I want to see where the leg two is. So the potential, and that's a key word here, nothing's ever 100%. At best, with price action, when you have the setup that you like to trade, at best, I always like to think of 60% at best. Sometimes when the trend is moving quite rapidly and you're able to jump in and buy the close or sell the close, in that brief moment, you have a much higher probability, 75%, 80%. So there is a potential that the market could still get to that. The same, that's why it's probably prudent not to always jump into trades. If you had traded it anyway with a low probability and said, okay, I'll take a low probability trade, that leg would have been a profit. But if you had been prudent and said, well, I can't see how to get in and stop off a range, etc., anyway, these are not successive closes on the end. The small pullbacks. If it was a bull bar after a bull bar, okay, if it was a confirmed breakout. What's a confirmed breakout? A confirmed breakout is when market breaks out of something. So here we're at the top of the trading range. There's no clear breakout of the top of the trading range. The first clear breakout we get is this bull candle here. Okay. Now, for the breakout to be successful, I need to see a second bull candle. Then when you start to get successive bull candles, you can just buy at the market on the close of that with your stop right here and wait for the pullback. But here we didn't get that, so there's no legitimate way to get in without a stop that's far away. If you don't want that stop that's far away, like I didn't want to, then wait for the pullback. Which would mean after the pullback, if you get the setup, remember I said what you're going to be looking for is to see what happens when you get to the moving average. We're going to get a double bottom, which will be set up. Then we need to see how to actually get the trade by a higher low, which we can take. Or if that double bottom does not hold, the market tries to break out, and as most breakouts fail and resume to give us a signal. Then we can take the entry. And we'll see what else you might want to test these levels. So you might want to test that or test that, but we'll see when we get there. Now, so the point of that is I have a level here, which if I do get a setup, this is where I want to be taking my profits at this level or just below it. Because I'm not the only one seeing it. The robots that are trading, the institutions that have created this move are seeing that move, and everyone will want to take profit. That's where you typically start to see a huge bear candle. It doesn't necessarily mean that the bears are assuming control, but what it will mean is that the profit taking is taking place. So you also want to be taking profits at that level. So this is one to watch. Now, how long will it take to set up? Who knows? You just have to be patient, because the thing that happens with when the market breaks a trend line, we typically enter, and when I say typically, most of the times we enter into a trading range. And as we enter into a trading range, the market is moving sideways. We are still in the higher probability of a bull trend resuming. What would show the strength of the bears is if after this strong move, and we've had, since that move, we've had almost 20, getting to 24 candles without any close beneath the moving average. If the bears are strong, and if this is not just profit taking, then what we would see is strong bear pressure and a complete candle that closes beneath the moving average with a gap between its high and the moving average. That we call that a moving average gap down. That would mean that the bears are strong enough to be able to put a full candle beneath the moving average. So they have strength. What you then need to look for now is signs that the bears are now resuming the trend, whether we see a lower high or another failed breakup of the trading range, and you see a higher high major trend reversal, or a high that fails, then you start to look for those opportunities. But again, the thing to bear in mind, if you continue to go sideways like that, if we get another setup above the high of the trade range, just exercise caution with that, because you always want to buy low in a trading range, whatever the trading range falls. Okay. So that's just looking at the monthly setup to complete what I look at on the monthly and the euro. So that's kind of what I look at. Now, once I'm done, some of these marks are marking a daily with the higher level view. I just leave it. Then I want to go down to the daily time frame. Okay, because for the monthly, I've got all my key levels marked. Then I want to go to the daily time frame. Now, excuse me. So from the monthly, I go to the daily time frame, with the exception of a Friday. The reason I say with the exception of a Friday is that on a Friday, if you trade on a Friday morning, because it's the end of the week, you always need to have a look at your weekly time frame. So this was a Friday. I'll just drill down to the week, and the only thing I'm doing at the week is the same thing I do when I'm looking at the lower time frame. What will be the high of last week? What's the low of this week? And if the week is ending and we're near the high of last week, that high is a magnet, either to pull the market up, for the bulls want to break and close above it, or to pull the market down, with the bears trying to pull the market down and keep the market bearish. So that's what you should be looking out for if you're going to trade any of the sessions on a Friday, because your weekly levels of support and resistance the prior week become very significant, and you will see that quite active in the lower time frame. So on the daily, remember I've marked everything now. All I want to just have a look at is, as I start today, to mark low of yesterday, high of yesterday, which is the red line and the green line on the 5-minute time frame. Then I just have a quick scan to see if there's anything else that I could be missing, any levels of support or resistance that might be coming in view that I have not marked. If there isn't, then I just want to confirm that I would have noticed a couple of days ago, last week, this 2-bar reversal attempt by the bulls to break above this high here, and then the next target is try and break above this lower high, because this lower high was significant because it created this low, a significant lower high for the bears would have been that, because they managed to not only bring the market back to this low, but to create a new low. So the bulls want to assert themselves by obviously breaking above that, which then nullifies the strength of the bears. The bears want to defend that, of course, because then they'll get a double top. And if they get a double top, then the only thing they want now is a lower high to keep trading lower. So it's just the view that you keep at the back of your mind. You don't have to memorize everything. The charts are in front of you, and every now and then you can just kind of go back and say, okay, where are we? And 80% of your focus should be on the chart that's forming in front of you. So what we have so far, remember that 20 pip range, so we've kind of extended a little bit out of that. The sessions range so far is 24 pips, and the whole range so far is 32 pips. So it's tradable. It's more than 20 pips, barely. But now we want to wait and see. We had the bears creating, bulls tried to break out, bears creating a double top. And here at the bottom, the bulls resisted the bears' attempt to break beneath the open of the day. So bullish strength, curbed, bearish strength, curbed. So this is what I call, or what is called, when I say what I call, I'm talking as a price action trade. This is breakout mode. The market will break out either out of the top or out of the bottom. And right now, so far, we're still inside yesterday's ranges. This dotted line here, I would take it off as soon as we breach it. This is the low of the session. This occurred in the Asian session, opened here, went down. So I just want to see what the low so far of the day is. Just to keep it there. But I tend to delete all of this to keep a clean chart, but for now, the focus of where we are, I'm going to keep it. So what are we interested in? Are we going to get a double bottom here from the bulls? And when you get double bottoms, you always want, I'm always looking for at least 12 bars separation. That's almost an hour of trading. You don't want a double bottom occurring just here, because that's strength, that's bearish strength, because it have done, bears come down to test this. They attempt to resume, they fail, and if they attempt to resume again and come down, bears are still strong. So now I'm looking for, and I'm saying I want to see a double bottom. I really want to see decent price action over 12 candles, at least 9 to 12. Once a big decent movement, if you get a double bottom, then we're waiting to see whether I get a higher low or a failed breakout and resumption up. Here's a classic one. If the market comes back to this level to give us a double top, that's fairly decent already, enough price action, double top. And all we need to look for is a lower high from the bears for us to trade back into the trading range first, and then see if we get a breakout. So that's coming up nice and slowly. Canadian is still going sideways, so we're just going to wait for that. Yen, we've kind of spoken about this, so that's going sideways. Well, sideways is a trading range, right? And have a look at this. I mean, we're talking 7.6 pips. If you're going to take a trade using price action on the 5-minute time frame, the minimum profit you should be looking to get is a 10 pip profit. Now, why would that be the minimum profit? The minimum stop you should be looking at, if you got a setup, is at least 10 pips, and that's because anything that's less than 10 pips, you don't get enough time to make decisions in a trading range that's oscillating around 10 pips. It's moving pretty fast. You could, if you can think and make decisions as fast as a computer program, but a 10 pip move is very, I mean, look at this. This is 7 pip, I think we said. 7 pip. Now, if you were to put your stop 1 pip below or 1 pip below that or 1 pip above that, already on the 10 pip move, but it's so tiny that you have to be making your decisions very quick in and out. You'll be in and out of trades, and you will make mistakes, make errors. So allow yourself, let the market move. Give yourself a 20 pip range, which allows you to put a decent stop, minimum 10 pip or 20 pip stop. And it's really just, by looking at previous price action, you see that, a 20 pip range, trading range, is decent enough to allow you to trade with a minimum 10 pip stop. Now, when I say 10 pip stop, so if you're taking it, let's say we're taking a trade here and we're happy with our range, our 10 pip stop is kind of down here, which then says if market moves all the way down, to my stop and it turns, I'm in my 20 pip range, because I'm expecting that a 20 pip range is a decent range for price action to move, to create movements within. So you're not going to get stopped out unnecessarily. Whereas if you put a stop just beneath your signal above, that was a setup because it looks decent. The market is going to try and make a 20 pip range at least. And you're going to get stopped out more often than you should. When you start to take more trades than you should and lose a lot more. When you are seeing things correctly, it's only that you're using a tight trade. So what you could do, because that's about 10 pips, you could put a measured move there. You say 10 pip move behind that is around there. A 10 pip move above the trading range is about there. So if I get price moving to that, that gives me almost 17 pips in a 20 pip range. So if I get a breakout above this trading range, fine, let it break out, let it confirm for me that the successive bull bars is working out nicely. Let it get to this measured move, because that's the measured move anyway. That's where the market is going to aim to go. Let it get to that level, let it test that, or break about it, then let it pull back. I already have my 20 pip. When I have my pullback, then I can look for my setup. If you don't get your pullback, like here, this was the breakout. I didn't get a decent pullback for me to remove an average, so don't trade it. A decent pullback that we're looking for is a pullback to the moving average, and we'll talk about that as we come through. So, guys, this is important to bear in mind. Having this 20 pip range to allow you to trade decently. Okay, we'll be coming up to an hour shortly. What I just want to do is, guys, if you have any questions, just pop in the chat box. I'll just check them. Just make sure I can cover that. Okay, so let's have a look at the Canadian long-term USD CAD Kiwi long-term. And I'm trading majors, so I just say CAD. Okay, so there this trading range that's been with us since 2015. So that level there is the high of 2015. So that's the level that's supposed to watch. And the low of this range is the low of the year 2017. Now, what's interesting with this particular trading range is that if we get a breakout, successful breakout beneath the trading range, now the market will tend to move, will be attracted to the measured move as a magnet, which will be right down near this low that we had. So there's a pretty significant magnet. The measured move is low of 2011. There's also this all-time low that we have way back here in 2007. So those are pretty attractive, pretty strong magnets that the market would like to go to. The one thing that you will find as you go through price action trading, and whichever way that you trade, you can apply this to the overall trading strategies. Because remember, whatever indicators that you use that work for you, they are seeking to read price action for you and give you ideas where to trade, where to take profits, where to exit, where to wait. Measured moves, if I can reiterate, are extremely significant, and markets are fractal. You've heard of that term, FRACTAL. Markets are fractal, which means whatever pattern that you see occurring on any chart, it will repeat itself, number one. So whatever we're talking about on the monthly, just bear in mind it's something that you can see on the 4 hourly, on the hourly, on the 5 minutes. And also, if we were to remove the labels, and if this was oranges or pears or bananas, it would be exactly the same chart patterns that you see. So there is absolutely no difference. So when you see this, whether it's on this time frame or any time frame, it's a clear trading range. and the market is been pulled down to that trading range. If we have a successful breakout, and a successful breakout, you need to see at the point of breaking out a strong trend bar, bear trend bar in this case, you need to see a follow-through trend bar to confirm the breakout. The size doesn't matter, but long as it's a trend bar that's confirming it. Then from there, you know you have a confirmed breakout. Now, if you want to trade breakouts, you're going to have to put a wide stop. Down here, your stop has to be there because the market can pull back. But we're not looking at trading initial breakouts. You got to wait for the pullback, and the pullback has to test either this level of the breakout or the moving average has come down, test the moving average or any other levels that we see, and then on the resumption of that pullback, then we want to trade. And if on that resumption we start to see successive activity, breakout, then we can look to trade. Now, if the question, what if you see breakout candle? You see the second breakout candle, you see the third breakout candle, and you are certain it's going to keep going down. You can take the trade. Point is, where do you put the stop? The stop always need to go where the breakout commenced. So if this candle here, this current candle, for some reason, the next 4 days, 3 days, just becomes a huge candle that closes beneath here. And then we have another one the following month, and another one. If you want to just jump in and say, I can't, this thing can keep on going down, where do I trade? You've got to put the wide stop. Because the pullback can start in time. It might carry on going down, but the stop has to go where the stop must go. So that's the view on the Canadian, the most distinguishing features. And if we come back to the daily, just a few other things on the daily. So earlier on, way back in October, we had this bear move that created a low and then a pullback. And if I just measured that last move, the measured move is somewhere within here. And the market did reach that at some point. But let's look at closer proximity to what we are seeing. We are in a channel of sorts. The market is trending down. But you can see what's happening here. Every time the market comes to a low, the bulls are buying. Low, the bulls are buying. On this low, the bulls are buying. So at this low that we've had, a few things have happened. Market did go down, pulled back. Bears tried to resume again, were repulsed, and now they've resumed. So there are 3 pushes. One of the other terms that you hear often besides measured moves, leg 1 equals leg 2, there's extensions. You start to hear about the number of pushes the market is making. When the market makes 2 pushes or 2 attempts to do something, it's a clear and fails, it's a clear alert that the next attempt that it makes to try and do the same thing, if that fails, we might get a reversal. A classic example is I've been talking about double bottoms. If we have a double bottom, that's the first low is the first attempt to reverse the market. The second low is the second attempt that creates a double bottom, but that doesn't mean it's a reversal. Now we know if there is a third attempt and if that fails, then we can confidently start to trade up in the direction of the bulls. So that's 2 pushes, and when you start to get pullbacks with the moving average that are clear, you hear me talk about, or here is a 2-legged pullback to the moving average, creating a low 2, so first attempt to go down low 1, then a low 2. But we'll talk about that. Those are patterns that we talk about here. The other kind of pattern is a third push, which is a wedge. A wedge is a triangle. It doesn't have to have the shape of a triangle, but what we're looking for is any 3 pushes that the market turns on. So for example, there is first push down, second push down, third push, on this bear bar. The market tries to break through, it fails, and it resumes. Here, there's a double bottom. Market tries to break beneath it. One, fails, tries again, fails. Now it's trying for the third time. But where it's trying for the third time is where we had a previous low. So it's a double bottom, but very poor signal bar by the bulls. But still, we have 3 pushes down, which is a wedge. We have a double bottom. Then the following day, which was yesterday, we had a bear candle that, it's a micro double bottom. That's double bottom, 2 bars right next to each other. If the bears were strong, the bears should have closed beneath this. Okay. But here today, the bears have broken beneath the whole pattern. If the bears are strong, they need to close with a strong trend bar. If not, you can expect that this low, this double bottom is going to hold. The market might go sideways, or might create tails. If create tails, then we can't take any short until we resume again and create a double top somewhere for us to see bear strength. And for us to consider bullish price action, we now need to see if this turns out as a bull candle today, the bulls resume under the bull candle, or if it's a doji and we have a successive doji, we want to see a strong bull candle occurring at some stage to confirm the double bottom. Okay. Once we have that, then again we start look for a higher low. If it fails, look for a lower low. If the bears are strong to follow up the micro double bottom and inside, remember again, most breakouts fail, and this is a pretty strong level. Failed here, failed here. We really need to see successive strength. So that's at a daily level. You've got to keep that in mind when you trade down to your 5-minute time frame. And again, you see on the 5-minute time frame, we are going sideways. Now, some of these things are like props, which you can put in if you want. You really want to see a break out of that tight trading range that's occurring here. So you can leave it there, or just the indicator. Okay, we're still going sideways in the yen. So what are we looking for? We're looking for double bottom. Okay, so on the bull case, the other thing we always got to bear in mind, there would be no market if the market was one-sided. It was always bullish, even if we have successive bull candles and the market is tracking up strongly. In order for that to be occurring, someone has to be believing, the opposite side of someone has to be selling in order for the transaction to take place. So at any given time, you always need to be thinking, excuse me, what's a bull case? What's a bear case? So the bull case here is we've had a small pullback bull trend, which is a very strong trend. Okay, very little pullbacks. We couldn't get in because on its initiation it was at the top of a trading range, and we never got any pullbacks to the moving average. We could have jumped in and put a wide stop down here. I opted not to, because I'd rather have a pullbacks to the moving average. So with the bull case in mind, what I want to see is a double bottom. And if I get my double bottom, then I want to see a higher low. And the thing to bear in mind always is that 20 pip range that we're talking about. We want to see the 20 pip range. At this stage, even if this candle closes above here, it's still a trading range. Although your case is strong for the bulls, a trading range, and you don't want to buy the top of the trading range. You want to wait for the breakout or that pullback to the moving average. So that's what we gotta wait for. We just have to sit patiently and wait. Now, as I said a few seconds ago, that the case is strong for the bulls, and the question is, why would I say that? The reason I say the case is strong for the bulls is because, again, of the small pull, the pull trend, very strong trend, small pulls, pullbacks. But although we're going sideways here, I mean, the bears obviously are trying to assert themselves as profit taking. The bears are not strong enough to have put a full candle beneath the moving average. So that indicates to me that the bears, while they're in the market, they're not strong enough. If they were strong enough, they would have at least put a candle with its full body beneath the moving average, leaving a gap between the moving average and its high. That's what we would call a moving average gap bar, which would simply indicate that the bears have strength. Doesn't mean that the bears have taken over. The bears have strength, but now I must be alert to see if double tops are created or if market breaks above the trading range, if it fails. So far, I don't see that. All I see in this trading range, where things are happening, many things are happening, but I'm seeing higher lows being created by the bulls. So I'm going to stay alert to that and see what might happen. At some point, I might get my 20 pip range, and the market comes back and tests this and creates another higher low, which should be fantastic, because now we're starting to look for trading opportunities. But right now, we've got to wait for it to play safe out. Okay, Canadian waiting and Euro waiting. Now, what I want to just talk about, I mean, the show is called bar by bar. And the reason for that is, as a price action trader, irrespective of the time frame that you are trading off, every bar provides you information as to what is happening out in this big wide world that is funneling itself into the currencies that you're trading. I mean, with the euro dollar, you literally are trading the sum total of everything happening in the eurozone and its interracial engagements with the world, and that's what's presented here on the chart. There are many different kinds of trade: institutions, algorithms, individuals, retail traders, us, who knows, governments, it doesn't matter. But all of it, the sum total is presented here. And with each particular move, information is being presented as to what the large institutions, the movers of the market are doing. What all we're trying to do is understand what they're doing. We're trying to get to a situation where we are 60% confident that what we are reading is accurate. 60% confident that what you read is accurate. Probably, I'm sure mathematicians would challenge me to say, how can you be 60% confident that you're accurate? But all we're trying to say, the pattern that I'm going to trade, when I think that I have a good read of it, my confidence level, 100% of my confidence level, is I'm 60% right. In other words, 40% of the time I am going to be wrong. And the only way I manage that 40% chance that I'm going to be wrong is by understanding and knowing where to put my stop, and that is informed by the information in front of me, and when to execute my trade. And that is presented as I start to look at the charts that's in front of me. So earlier on, when we spoke about this double top that was created, and that became the high of this particular session. And just above that, we have the high of yesterday. And we are within the yesterday's trading range. That's where we are on the euro at the moment. Depending what happens on the day, if it ends up as an inside candle, Any inside candle you see is breakout mode, because market will want to break out of that. And again, remember, most breakouts fail. So, fail breakout, come back, etc. If you get an inside candle, it's breakout mode. If we have an inside candle, that's also a stronger breakout mode. We will look to see if it breaks out, comes back, pulls back, I must trade. So at this current moment, we are inside yesterday's zone, and we've got to keep looking at what information we get. So this double top has so far shown us that the bears were strong enough to defend that level and to defend the high of yesterday. So if I get any trade that I'm going to take, the most significant level that's going to be defended is this particular level. If the bulls can break above that, they are nullifying the case of the bears, because the bears are failing to defend that high there. But if the bears can defend that high, no matter what happens in here, that means they are strong enough to keep holding that 2-bar reversal. That's a level that I must bear in mind. If I'm going to take any short, if for any reason I look at this and I say, okay, I think the setup is okay, I'm kind of within my 25 plus my 20 pip range. I've now seen a double top. Let's say it turns somewhere here. I see a lower high, and I want to trade somewhere within here. The only place I can legitimately put my stop is up here. Okay, that's the first thing you always have to bear in mind. Anywhere that I decide to trade, for whatever reason, if anything sets up, that's where I've got to put my stop. That's going to be defended. Why do I put my stop there? Because that is the most significant high out of which a reversal created a low. So from here, we had a two-legged move, market move down, pull back, and turned here. So remember we spoke about two-legged moves. Here's just an example. Market moved down, pull back, and moved here. Let's have a look at something. Always think of the market. So Fibonacci, I use the expansion tool. So there is the market moving. There's the first leg where it ended. And where did the pullback resume? So the pullback resumed here. So there is the first move, pullback, and the second leg. Now, the second leg ended almost virtually at the leg 2 move. So these are precise patterns that computers follow, and you get to learn to see them. We didn't trade here because we are not within our 20 pip, but assume you were, you have taken that trade, held on to it, even through all of these pullbacks. I mean, unless you get a clear reversal, I always prefer to hold on to my trade, so I don't onto my stop, so I don't second guess myself. The market comes and turns here and yet you're out and you try and scramble to get in. So leg 1 pullback and leg 2, and the leg 2 began here. You could have looked to put a trade there or put it there assuming that you want to get here, but your stop is still going to be there. But it's a clinical move at the market move. But the point is, the stop always has to be in the correct place. So we have that, and we also have this level that we have here. Now, the bulls are moving up in a tight channel. Okay, it's a tight channel. When we speak of two-legged moves to the moving average, if this was a breakout that we were trading, and you say I'm waiting for the pullback, you'd wait for the market to come back, pull back once, attempt to resume again. That in a bear trend would be a low one, an attempt to create. So you have the market move back, market resume, and attempt to create a new low after the pullback. If that had triggered, we would have called that a low one. But it didn't trigger. Market resumes again, and attempt to create another low, because we never had, sorry, excuse me. So that level there, that bear candle does not qualify as a low one. The reason is when the next candle opened, it did not fall beneath that low. So the bears were not strong enough to use that opportunity to break beneath this low and create a low one after the pullback. So the market resumed again, and then we had this second attempt by them, and barely broke through, micro pip and double bottom. So the bears are not strong enough to put to break a low. Here they've broken the low and resumed. What you want to see for you to take any trade, say, hey, hang on, I see four bear candles. Let me take a trade. Well, first see a break by the bears of one of these lows. The bear candle, it's a pause, profit taking. They're trying to create a reversal, but they're failing. So as long as we have that tight channel, it's still part of the pullback. Okay. So again, what's been created here? It's a trading range with highs, lows, breakout mode. Because you're in the trading range, at this stage, what do? If you kind of said, well, George, I've looked at all the charts, I've looked at what happened before, the Asian session, I've looked at this, I've looked at that. I think the market is going to go up. Well, you're right in the middle of a trading range. If you think it's going to go up and you're going to buy, well, buy, but guess what? Stop has to be way down here. If you think, well, double bottom, double top, etc., let me sell, stop has to be way up there because a trading range is being created. The only way to trade a trading range is wait for a double top, and not the only way. The best way to trade, you can trade anyway. The fact that the market is moving up and moving down, it means someone is in this tight channel, someone is making money. Bulls and bears are trading, whether it's the algorithms making micro pips, it doesn't matter. But fact the market is moving. But it's a very tight channel. 5 pips top to bottom, nowhere near our 20 pips. It's a very tight bull channel, and it's showing bullish strength, but in the middle of the trading range. So we're going to have to wait. We might still get there in this session, the European session, or we might get there on the open of the US session. I prefer, my goal, and I really keep working on my energies to trade all sessions. Tokyo session, which is 2.5 hours, the first part, the morning session. Then I want to trade the whole European session, which is the open of the London Stock Exchange. And I want to trade the open of the US session, which open of the US session takes us to the close of the European session. There is significant movement there. Then, of course, if the market always moves. How many times do you, especially guys in the Asian session, if you get up, you look, you see what's been happening on the left of the chart, which is the European session. So there's always trading opportunities. But of course, you can't trade 24 hours a day. That's why I try and optimize. I jump into the Tokyo session because 2.5 hours, I can jump back and get an hour sleep, and I can still sleep a good few hours before I wake up. Now I'm fresh enough to trade because there's typically good moves that happen, especially I've noticed with the yen and the Canadian pairs. I'm talking about the majors here. Okay, so we're in the middle of the trading range. That high in the open of day in this US and the European session. So we're going to just keep watching that as we go along. As I said, on the day, you can see what's happening on the day. Now, each bar gives us information. As this formed, because we're talking elsewhere, this pattern created, which is it's another example of a small pullback bull channel. Remember, we had this on the yen, a small pullback bull trend, where it's very hard to jump in. It's very hard to jump in if your strategy is to trade clear pullbacks to the moving average. Okay, so I can repeat that. That's the only reason it's hard to jump in. Otherwise, you can jump in at any time. Put the correct stop. At any time, you can jump in, put the correct stop, and then manage your trade when you start to see a reversal thereof. So it's just important to bear that in mind. The strategies I'm going to be talking about, that my preferred strategies is pullbacks, two-legged pullbacks, some level of support or resistance, preferably to the moving average. But having said that, your stop, now I said your stop is in the correct place. As long as your stop is in the correct place, okay, there is absolutely nothing stopping you from trading. You could even have said, if you wanted, well, I like that, I'm going to put my stop at the bottom of the trading range, put a 15 pip stop, and take it's a low probability trade. Low probability trade means you lose a lot more than you gain. I have my lowest probability trades are what I call major trend reversals. In other words, we have a trend like this small pullback bull trend that we have. I'll get that to you just now. And when that trend breaks, there's a trend line break, so it's a major trend reversal. I want to see if the bears are going to put that moving average dead bar down here. And the bears do that, if I see later on a double top, a lower high, and a good signal bar, I'm going to take the trade. Now, that's an MTR, and we'll talk about it. And as we go through week after week, I'll start to show you that today is like our beginning day. I'll start to show you that this is what came out on Thursday, etc. So you start to see some of these patterns. But the major trend reversal, once it sets up and you take it, it only has a 40% chance of success. Okay, which means out of 10 trades, you're going to lose 6 of them. If you manage your trades correctly and you see a reversal, it's possible to get out without your stop being hit. But let's assume your stop is hit at the level that you set it. Out of 10 trades, you will lose 6 trades. But you will win 4 trades. And the 4 trades that you win, just to look at what we have here, let's assume you take the trade, 10 pip, stop, whatever. If it works 40% of the time and you manage it correctly, on that one trade on its own, you can make it 3 to 4 to 1. But that's not all. Along the way, you get pullbacks to the moving average, which you can add onto the trade. But it's a 40% chance of success. The reason I'm pointing that out now is that if you decide to say, hey, I've seen what a small pullback bull trend could do, or what a trade at the high or above or high of a moving average, so if a trading range can do, I'm going to start taking those trades. Understand those are low probability trades. You're probably going to win 20% of the time. Now, you need to work it out. If you're not going to win 20% of the time and lose 80%, are you going to make money out of 100 trades? You won't make money out of 100 trades. But with an MTR, a major trend reversal, 40% chance where you can make a 4 to 1, you will make trade. But you can test these things for yourself and decide when you want to go. So I will show you, like here, you could have taken a trade. I'll show you where to take a trade, but it's not my preferred. I will emphasize and highlight the trades that I prefer to take. Let's go back to the euro. Again, just talking about what's happening on the bars. So as this were forming, each bar is giving us information. The fact that we are not getting any bars breaking below the low of the previous candles showing us bullish strength. So the bulls are strong, which is good for the bulls, because if we then get another break beneath this pattern, so here the bears put a 2-bar reversal, almost a 2-bar reversal at the moving average, hoping to do a double top here, and they broke beneath that, and that's good. So that's a decent break beneath that. But immediately it was reversed. Now that's the first distinct sign. We had a small break here, which counts, but we have a second break here, a bigger break. We see still a bull candle, but the bears have managed to put a small break and a second break beneath a bear candle. So the bears are starting to show some strength. Okay, bulls still controlling because we are going up at a higher low. So now, what we'd like to see is this bullish strength. If the bears start to put consecutive bear bars up to test this level, how are they going to be putting their bear candles? Are they going to put 1, 2, 3, 4 like they did here, 4 strong candles, one after the other, to test this low, and then are they repelled or do they break through? Because if they start to put 4 strong candles like they did here, and the bulls are not able to create bull pullbacks within that bear candle, that bear leg, it means the bears are getting strong, because this is such a strong bull move. The bulls are strong enough to put this kind of tight small pullback bull trade. They should be able to create a bear leg in a trading range. Now, what do I mean? It means the bears are going to test this low. If the bulls are strong, they will keep buying every single bear candle, and you start to see small pullbacks, which could almost look like this, but it's showing us that the market is not completely one-sided. Here, 1, 2, 3, 4, the market was completely one-sided until we go to this level. So the point of this is, even though you're in the middle of a trading range, you can't ignore what's happening. If the bulls are able to create and ensure that the bear leg is weak, in other words, it's two-sided. And then if coming out of here, you get something that's two-sided. In which you kind of get down here with two-sided price action. It's still a bear leg, but it's now just a bear leg in a trading range. And now, if you then see a double top, then you can say we got our setup. All we need is a higher low to go long, because the bulls were able to weaken the bear strength. But if they're not able to do that, and the bear leg that is created for us is just one bear candle after the other all the way here. In our minds, you've got to be prepared to say we might get a bear breakout, get a pullback, and go short. That's why it's important to look at each bar by bar. You don't necessarily have to be watching each candle. I mean, like right now, we're looking at this. We can flip through to the end, so we know what we are expecting. The bulls are strong, then just give us our 20 pip range, because we really want to see that. Okay, because the reason we're saying that, put another prop just to help us visualize what's happening. Okay. You can put this in and out, it's going to help you. The reason I'm putting that is that this pullback has been a trading range, right? Trading range pullback to the moving average. Breakouts fail. Breakouts above trading ranges tend to fail. So if I don't see that and keep that in mind, I'm going to just jump into a trade which might just end up cascading downwards, and I lose money thinking I'm going long. So if the bulls are strong, there is the breakout candle. I mean, they did the absolute minimum. I would have wanted to see a strong bull candle closing above that. Then I can confidently now start to look at, if I get to my full range, look at my higher lows and say, well, if I get an entry there, I'll take it. So it's probably the most important thing you can do is not to get sucked into every single thing that moves on the chart, but just wait for, this is what I'm looking for, and when I get what I'm looking for, then I'm going to trade, because if it moves in my direction, I can take in pullbacks. I can just keep on doing that, and make the returns that I'm looking for. When I just look at the CAD. The CAD is still in there. I want to show you something briefly, just to illustrate the point. I think it was yesterday. Okay. This was the day before, right? It's almost kind of similar, except this is not starting. Yeah, almost. So this is what happened with the yen. Except this move started about 8:40. So in that move, I'm not in the market because I'm doing 2 to 4:30 my time and back in for this session. So this session starts here, European session. This is, I don't know if this is what's going to happen today, but this is what happened. A small pullback, bull trend. Exactly what we're looking at. Very hard to get in. There's no pullback moving average. But if you want to jump in, what you do, the stop has to go down here where the breakout started, and then you can just jump in anyway. Buy above the close, do whatever. Just buy, put your stop in right place, and manage your trade. When you start to get a pullback, you can get out of it, make some money. But I prefer, as I'm explaining, pullbacks to moving average. So, and this is similar to what we had. So the market pulled back to moving average, so we broke the trend line. So now this is a classic major trend reversal pattern, NTR. Let's put that US words. You start to see some of these acronyms as you go through. So NTRA, I'll explain that. It's a major trend reversal. Alert. That small a means alert. Okay. So this whole pattern here is a major trend reversal alert, and that's what we'll be forming on today. How does it work? You get a trend. It could be this kind of a trend, or it could be one of those broad channels, okay, which allows you to keep tracking to the moving average and trending up, taking trades up. But whatever form of trend that you have, you can clearly see the trend line. Then we have a break of the trend line. Now, when you have a break of the trend line, we want to see the market coming to test the moving average, and preferably you want to see the bears putting a bar completely beneath the moving average. Then you want to see a resumption of the trend, because these bulls that put the one resuming, so they might be going for leg one pullback, leg two, somewhere up here. But if the trend is going to fail, at the top it must fail, the breakout must fail. And then the bears resume again, and again you want to see they put a close beneath the moving average, but they have not put a full candle beneath the moving average. So, they need more to build their case at this particular stage. That's on the bear side. So the market is still going, still bullish in favor in terms of the likelihood of resumption. Because I want to see the bears put a full candle beneath the moving average, and I don't see it. Bulls try to resume, with a decent reversal candle here, so double bottom reversal, but there's no follow through. They fail, bull candle, they fail, and that starts to turn down. So that's a bit of a low high. Bulls come back in again, but you're in the middle of the trading range. And like I said earlier on, don't initiate any trade in the middle of the trading range. I mean, you could have put, if you wanted, say, I'm going to put in buy above that, 1.5 people, whatever. If you get triggered in immediate turns, you have to just take your loss. But you're in the middle of this small range, so that's not a good thing to do. Wait to go to range extremes. But the market does not get up, so immediately it turns. So here's a bit of a problem. I didn't get my one candle I look for, or series of candles where the bears would have put a bar completely beneath moving average. But they break out quite strongly beneath this trading range here. Okay, they break out beneath that. Do they put a follow-through bar? They have an inside candle, which is breakout mode. They fail to put a follow-through bar. So at this stage, I'm kind of stuck because I would have wanted to see a double top somewhere here. Then I can confirm, okay, I've seen a double top. Wanted to see that moving average depth bar. There's a strong double top. Then I can comfortably trade it. Now we are back again in a trading range. So there wouldn't have been much appeal to take any trade here because this could reverse. The market could simply be testing a 50% pullback of that, and that's something we'll talk about when it materializes. 50% pullbacks are also very key levels to measure. So the markets. So at that point, it could simply be a test of 50%. It's a key level, price action level. We get a full breakout, small pullback bull trend. 50% is always tested. So that could simply have been a test. So you can't go and trade that because the market could turn there, and you're in the middle of the trading range. If it turns there, it gives you a decent enough bull candle. That would be a good trade to take because the double bottom, failed double bottom is 3 pushes, 1, 2, 3, reversal, take long. Again, it sounds a bit of crazy at the moment. Just think of the 3 pushes. We'll cover that more and more as we go. So there will be nothing to do there at that particular point. Then you just have to wait until you get here and wait to see what happens. The bears are strong. The bears are this strong because, like I'm talking about on the euro, the bulls were not strong enough at this stage to put pullbacks to the moving average so that we have a weak bear channel coming to test this low. Instead, the bears were strong, which means the bulls have stepped down. So there are chances that the market might go lower. But where is it going to go low? That becomes a question. We come to this particular point. We get three attempts to break beneath it. There is the first one, market pull back. There is the second one, market pull back. There is the third one. So we have another 3 push, which kind of indicates the end of that particular move. But the bears are strong. So now I want to see if I'm going to get my 2 pushes back, 2 pullbacks to the moving average. So remember what I was talking about. This is a pretty classic example. There is the first pullback. The bears are strong enough to create a low one, the first low one after the pullback. So they've broken that low. That's the first low that's broken the pullback. And that's fantastic. Now, all I want to see when I see that, I want to see, because I want to take it off the moving average. Why the moving average? Well, the moving average is the average price, an indicator of the average price of the day. And if that's the average price, that means bears who are not active in the market are going to say, well, hang on, it's maybe a little bit too expensive for me to trade here. Let me wait until I get the market coming back to the average price and trade. There we got a second entry, which is a low one, a low two, and that's a classic trade to take. Second move at the moving average, and just put your entry beneath here. Your stop has to go way back. Okay, that lower high created this low, so that's where the stop goes. So the stop will have to go there for now, and right up until you get another new low, and you get a pullback. So if you take any trade here, now you can put your stop there, pull that stop down to here, and you carry on. But that's a major trend reversal, and that's a classic low one, low two. I prefer to wait for low two. Sometimes you don't get a low two. Sometimes you get a low one. The market resumes, and that typically happens if you've had consecutive bear bars without any small bull inside. Get a low one, market resumed, and as trading first pullback after a breakout, and we can talk about that in the right conditions. Okay, guys, if there are any questions, just pop them into the chat box. So I thought I'll just show you that. And that's another classic example of waiting patiently. So you would have been able to take that trade. You would have been able to take that trade, put your stop there. Now you would have taken that trade, waited, get a pullback, and just filter it into the open of the US session. So by waiting, you would have been able to secure yourself some reasonable returns. So it's interesting that I showed that, because what is happening here is pretty interesting. Remember, we had that trend line here that I drew. Those high lows, and that's been broken. So that's irrelevant. The trading range pulled back to the moving average. Market tried to break up on that, it failed. So the bears were able to create a failed breakout. Now this now becomes it's a major trend reversal alert. So we are in another major trend reversal alert. It's an alert, guys. It is just an alert that the trend may reverse. Remember, MTRs only work 40% of the time, and if they work, you have the possibility, opportunity of making 4 to 1 return on the early trade plus whatever else you can add on. But it's a major trend reversal alert, which means it may fail. If you take the trade, if it fails, which it may do, which it may do, manage your trade and get out where you can. If it reverses quickly and your stop gets hit, that's fine. 4 out of 10 chances you make money. 6 out of 10 you lose. That's also okay. Okay, so now we are still in that major trend reversal alert with a break of our trend line. Let's just put the 50% of that move, 50% of that whole move. That's a 50% figure. Now that's pretty interesting, isn't it? That 50% pullback. Let me tell you why it's interesting. That 50% pullback is exactly a measured move of the breakout of that trading range, type trading pullback to the moving average. Isn't that interesting? So these moves, these price action moves, they're all scientific, they're all driven by computers. The market likes to test 50% pullback. So the market is putting a trading range pullback to the moving average. All it means is the computers are aware that if you break beneath that, okay, if you're able to trade fast enough and small enough, you can take a bear trend right up to here and take your profits there. Or wait to see if that measured move will be reached if you break beneath it. Wait to see if the measured move tests over the 50% pullback we then get a decent reversal candle and trade that long. Now, why and how would you do that? One thing needs to happen first. I still need to see. Now, I'm talking if you're going to trade the 50% pullback, let's talk about that first. Remember, when you're trading range, you're putting both sides looking both sides of the market. I need to see a double bottom here first. I need to see the bulls create a double bottom. The market can then resume comfortably. When the market resumes comfortably and the bears will create a double top, initiate a sell, and the market comes and breaks through the double bottom and then fails. Okay, it's broken through a double bottom that has been created here and then fails and gives me a nice reversal here. I will look to trade that long. The reason I would do that is that market has come down once, attempted to resume, has come down again, create a double bottom. Okay, and the bears continue to repulse, comes back and creates a third push down, which is a form of a way, so third push down. Then it's failed, means it has failed to go down once. Come back, it's failed to go down twice, that's the second double bottom, and it resumed. It fails again the third time to break through a key level, like a measured move of that pullback, and a 50% pullback. If it's failed 3 times to break through key levels, then I'm going to resume. I'm going to trade that long. Okay. All right, guys. If there are no questions, we've got 3 minutes to go to our end of our session. We will catch up with you all again next Wednesday. So I'll just watch for a few more questions. So we've got a few things that we must just keep watching out for the rest of the day. Euro in the middle of the trading range, we're going sideways when I see if we get a double top there, lower high, double bottom or lower high. CAD, these are majors. It's looking to break beneath that level that we spoke about, to give us a 20 pip range. This is the current low of the day. Let's see if we get a nice breakup, follow through, whether we get lower highs. And the yen, we are in a major trend reversal. I'll keep track of this, and hopefully we can show you what happened for next week and anything else that comes up. Thank you, guys. Thank you, Mai. Appreciate it very much, and we'll catch up again next week.